The coronavirus has shaken up the financial markets in a way that's rarely seen over the past several weeks, mainly because of the uncertainty over how bad this epidemic could get, and more importantly to the markets, how much its ramifications will create economic damage to the world economy. It's exactly this kind of uncertainty that causes the options market to experience huge spikes in implied volatility, which is the main factor that drives the pricing of options. I'm the head trader of SMB Capital's options trading desk, and right here at SMB's trading floor in Manhattan, I have the privilege of working with spectacularly successful options traders that know how to exploit market panics, just like we're experiencing right now. In our last video, we talked about just such an opportunity, namely selling puts when the market has experienced a huge spike in volatility. In this video, we're going to take that discussion one step further and look at what would have happened if the market had sold off so hard that the short puts that we sold went into the money and we were assigned the shares that those short puts represented. If you'd like to learn how to make even more money from your options trades when that exact situation unfolds, then stick around because I think you're going to find this very interesting. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so if you're even remotely watching the financial markets, I don't have to tell you that the market has gone into a somewhat unprecedented period of volatility based on concerns about the coronavirus and its economic implications. Over the past few weeks, the market has experienced some of the largest point moves in the major indexes in the history of the stock market. And in our last video, we discussed selling SPY puts in that kind of environment and how quickly those trades can work out in a very profitable way. Today, we're going to look at that trade from a different perspective, and that has to do with the case, which certainly will happen now and then, where you sell puts when the market's going down, looking for a fast, profitable trade, and instead, the market sells off past the puts that you sold, and you actually get assigned the shares of stock to which the puts pertain. So, before we go any further, let's make sure that everyone listening has a full grasp of the way stock options work. If you already know how options work or you watched the last video, this is going to be super quick, so hang in there. So what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is trading at. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option and the seller could lose money on the transaction. But if the stock on the expiration day of the option is not beyond the strike price of the option, then the seller just pockets the premium that he was given by the buyer. He walks away completely free of any obligations. The options, in other words, expire worthless because it was never triggered. So what we'll be talking about in this video is where we are selling put options below the market and collecting a premium for doing so. If the market does close below the strike price of the put options we sell, we'll be obligated to buy the shares at the strike price of our option, even if the stock price has dropped well below the price that we'll be obligated to pay for them. So like we discussed in our last video, the market was crashing downward the morning of February 28th, and at around 10 a.m. we sold 3 puts on the SPYs that were due to expire that day, and those puts were very far out of the money at 277. By the end of the day, the market had bounced and those puts expired worthless. But what if the market had continued to sell off and the SPY closed below those puts that we sold? Well, in that case, we would have been obligated to buy those shares at the strike price of our put option at 277. So what we'll be doing in today's lesson is taking a look at how many options traders would handle that situation once they own the shares that were assigned to them. So to do this, we're going to be looking at another case in the past. And so let's go back to December 21st, 2018. And as we can see, the market was selling off that month, down 16%, in fact, from its all-time highs at that time. And so you decided that the market was cheap enough and that you'd sell 3 of the 245 puts for $1.21 each. So to be clear on that calculation, if you sell 3 puts for $1.21 each put represents 100 shares of stock. So as you can see from the calculation, you'd have received $363 for that. So now let's think about the position that the trader's in. If by the end of the day the SPY closes above 245, then he'll simply pocket that $363 and have made a successful trade. On the other hand, if the market closes below 245, then he'll be assigned those shares and be required to buy them at 245. Now, before we get into how this trade turned out in the unique way that this trader was able to use options to turn a very nice profit, I wanted to let you know that there are sound, viable, long-term techniques for trading options for income that go way beyond this strategy that we'll be discussing in a minute. And in fact, we are currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world like Warren Buffett use all the time, plus an options strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now at this point, the trader had sold his 3 puts and collected $363. And so if we move to the end of the day, you'll see that the SPY closed at 240. And so the owner of the put would have exercised his right to sell you his SPY shares at 245 because he'd make about $5 per share from that transaction because his shares were valued at 240, but you were required to buy them at 245. So at this point, you're now long 300 shares of stock. Now, if you really have a conviction that the stock will bounce, then you're happy that you've been assigned these shares. And if you are right, then you've collected $363, plus you now own a stock that you're very bullish on at a great price. At that point, you could simply hold those shares, and that would have turned out pretty well, as a matter of fact, when you consider that the SPY traded up as high as 339, at which point you would have been up over $29,000 on the trade at its highs. On the other hand, if you didn't want to tie up your capital on the SPY trade for whatever reason, you had another alternative you could have chosen. And that was to instead exit the SPY shares by picking up some more income using what is known as the covered call technique. So let me show you how that could have played out. So on the day after you were assigned the shares, you could have sold 3 calls at 245 at the same price you had to pay to buy those shares. Now, this is done intentionally because if you think about it, if the owner of the call decides to exercise that call right that he has bought, he'll have to pay you $245 for those shares. Well, that's exactly what you paid for them. So that's a wash. So the only thing that would be left is the premium that you received for selling the calls. So let's take a look at the cash flow that we received from this exercise to make it clear. As we discussed before, we received $363 already from selling the original 3 puts that caused us to be assigned the shares of SPY in the first place. But remember now, we are also receiving cash flow from selling those covered calls in the amount of $525 for a total of $888. So now keep that cash flow in mind because 4 days later, on the expiration of those calls, you'll see that the SPY had rallied to 247. And so the owner of that call is obviously going to exercise his call, and those shares will be sold to the call owner at 245 at the very same price you were required to buy them from the guy you sold the puts to earlier in the trade when you were assigned those 300 shares of SPY at that price of 245. a share when the shares were trading for much less in the open market. And so naturally, when you set the location of your covered call, you did that intentionally at the price that you paid for them so that you would not suffer a loss on the shares if your shares were called away. So then what's left? Well, your shares are gone, but the $888 you collected by selling the puts and the calls, those are yours to keep. So now, before wrapping up, I wanted to reiterate something very important. This entire campaign started with the notion that you were very happy to own SPY shares at $245 because you thought that if SPY hit that level, it would certainly bounce. So you didn't actually care if you just collected the put premium and weren't assigned the shares because you would then just pocket the put premium. Conversely, you were also happy to be assigned the shares because you consider that to be a great price to own them. And at that point then, you're in the driver's seat. You have pocketed your put premium, and now you can either hold the shares and benefit from what you believe is going to be a bounce, which actually would have worked out really well here because SPY ended up at $393 like we discussed it earlier. Or alternatively, if you didn't want your capital tied up with the SPY shares, you could always exit them through selling a covered call like we showed you in this example and pocketed some additional income from the call premium as we just demonstrated. Either way, you're a happy camper, and this is a great example of the flexibility and creativity afforded to you by options trading. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in the new window so you won't lose this video, don't worry. Or you can just go ahead and head over to optionsclass.com to register for this free intensive workshop. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it.